Welcome. I'm Terry Cohan-Link, principal of LINKCO. Greetings, good morning to those of you joining us from the Western US and Canada, and good afternoon and good evening to the rest of our audience. Thank you for attending the webinar, Avoiding Greenwashing Pitfalls. I will introduce our speaker in a few moments. The Resilient Realism webinar series, developed out of insights shared by business leaders about the dynamically shifting business climate. Early conversations resulted in the white paper entitled Resilient Realism, and you can find it on our website. We're thrilled to welcome you. Many of you are returning participants to our series, and we thank you for joining us again and again. And for first-timers, you may be wondering why LINKCO, an executive search firm, moderates webinars like this. The answer is it's our way of giving back and sharing relevant information we learn interacting with business leaders on a day-to-day basis. In the wake of COVID-19, here is what we are noting. Business leaders are grappling with the risks and economics related to their personnel, physical, intellectual assets, products, and services. The disruptors and challenges, opportunities, and insights that LINKCO has focused on in our webinars to date include remote hybrid workforces and physical workspace demands and expectations, how to manage business risk, work product, remote cybersecurity practices to protect assets, employees and clients, dynamically changing logistics and transportation, environmental impacts of the pandemic, what is ESG and how do we pragmatically measure and audit our success, and how real is green investing, and how to evaluate and plan for climate risk. Today's webinar focuses on avoiding greenwashing pitfalls. We hear the term greenwashing used all the time, but what does it mean and why is it critical for you and your company to understand the slippery slope of greenwashing pitfalls? How can improving your green credentials positively impact your company's bottom line? Stay tuned for additional webinars on this and adjacent subjects as this is a rapidly changing environment. At the end of the webinar, we will announce our next upcoming webinar and who is coming back by popular demand. Links are on the LINKCO website. A little housekeeping. Today we'll begin with our speakers setting the stage for better understanding of greenwashing. After this introduction, we will open for questions. Some of you have shared your questions beforehand, and those are already in our queue. For the rest of you, please take advantage of the question box, which is located on the side of your screen, for additional questions during the webinar. Dr. Todd Cort works at the intersection of sustainability and investor value. Over the course of 20 years in consulting and academia, he has applied a scientific and economic lens to corporate, social, and environmental responsibility, sustainability, in order to identify the tools, mechanisms, metrics, and indicators that create the greatest value for investors, businesses, and society. His experience ranges from on-the-ground implementation of sustainability programs to corporate-level communication and investor strategy development. He has also worked extensively on integrated programs meeting regulatory requirements by communicating with internal stakeholders, communities, policymakers, regulators that promote awareness and understanding of sustainability. Todd is currently a faculty member at the Yale School of Management with the courtesy appointment at the Yale School of the Environment. He serves as faculty co-director for the Yale Center for Business and the Environment and the Yale Initiative on Sustainable Finance. He serves on a variety of advisory boards, including the Just Capital Scientific Advisory Board and the Prime Coalition Academic Advisory Committee. He is also currently a board member and treasurer for Save the Sound, a regional environmental nonprofit serving communities all around Long Island Sound. And Todd is a budding organic wine maker, and I'm going to ask him a question about that a little bit later. Let's now start our conversation. Todd, I'm going to hand over the webinar to you. Give me a second. But first, let me share.
While you're doing that, Terry, I recognize a few of the names in the group here, and one former student, which is flattering to suggest that I've got anything left to tell her after she's been through the Yale curriculum.
Please go ahead.
All right. So, thank you, everyone. Thank you for joining. Hopefully we can give you a little bit of valuable information over the next 30 to 60 minutes. So the remit here is, the pitfalls of greenwashing and how to avoid them. And it'd be really easy for me to stand up metaphorically and tell you that, you shouldn't greenwash because you'll get caught. But that is an oversimplification of what has become a fairly common public relations strategy, and one where the nuance of what counts as greenwashing and what counts as green promotion has become very, very blurred. So rather than do that, what I want to do, or what I thought I'd do, is I need to step back, and we need to talk about the ways that environmental information, or the ways that environmental impacts and risk create financial risk to a company. And only by understanding those internalization processes can we then evaluate where greenwashing is either effective or dangerous. So I'm going to go back a little bit to talk about the way that environmental information creates financial impact for companies, so we can look at those strategies a little bit more deeply. Just to quickly level set, there's lots of definitions for greenwashing out there, and they're all legitimate. I pulled this one from a website from the Solar Calculator, who has a kind of an embedded interest in getting verified green information from their clients because they're a solar company. But what I wanted to point out in this definition is the word deceitful, because that's really what most people are thinking about when they think about greenwashing. They're thinking that the company or the organization that is making the green claim is doing so in a non-candid way. Is doing so in a way that their actions would belie the claims of their green credentials. I want to be a little bit careful though here, because deceitful implies that there is intent behind the lie. And greenwashing is actually can be much broader than that, because companies are complex organizations. And a lot of greenwashing occurs when one section of the company is making claims around, green credentials or green performance, and another part of the company, completely unbeknownst to them, is doing something that would counter those claims. And one of the most common areas of greenwashing we get today that are hitting the headlines is where a company is making claims around its environmental responsibility, say its greenhouse gas emissions reduction or its climate strategy. And at the very same time, the company's public relations and lobbying is actively trying to inhibit or prevent regulations that would presumably solve or help solve climate change. That could be happening without the two parties knowing about each other. It could also be happening because there are nuances within that regulation that do not appeal to the company, whereas the overall regulation, to solve climate change might be appealing. So it's not always a deceitful practice. in greenwashing, but the core of it is that the company is making claims that could be proven incorrect by an outside observer based on your actions. So we're going to try and, given that nuance of what greenwashing is, again, we have to step back and say, well, what exactly would we use greenwashing for? Why is it a strategic solution that a company might employ? So to understand that, we have to think about the company in context. So here's our company, big blue circle, but it is in an operating environment. So the company is dependent on resources, stakeholders, et cetera, that are outside of the company. And therefore, it has impacts that come from outside the company. So just thinking in the environmental space, there's climate impacts, there's climate adaptation challenges, severe weather, drought, et cetera. The company has to operate within all of those, within that context. But those by themselves do not cost us money. So I can, as you know, severe weather in Louisiana does not impact my university here in Connecticut for the most part. There's for the company to have a financial impact, or for the environmental risks to become financially material, requires some sort of an internalization pathway. So some way that external risk manifests itself into an internal financial impact. And there's really three ways that this can happen. You can have either a governance, or excuse me, you can have either, I think it's the next slide. You can have either a regulation, which is where a government forces the company to consider the external impact. In fact, for most people, this is essentially the role of government. For those of you who are Milton Friedman experts, you'll recall that Milton Friedman talked about the business of two parties transacting is to maximize the benefits of those two parties. But if a third party is impacted by that transaction, it is the role of the government to make sure that that impact is taken into account. So that's what government does. The government is there to ensure that externalizations that are worth or that are valuable to a third party or a party outside of the transaction are considered as part of the transaction. And a lot of environmental impacts fall into that category. A second way that it can internalize, or an environmental aspect can internalize, is through a civil society movement. So for example, if you had a product that was shown to be environmentally irresponsible, and most of your consumer segment really, really cared about environmental responsibility, then you could see, a movement against your product. You could see a boycott. You could see lobbying on behalf of your consumers or civil society to regulators to ask them to act on their behalf. So you can get backlash from civil society writ large. And the third way is that you face a physical constraint from a capital. And these capitals could be a financial capital. For example, you are no longer able to access financial capital as a result of this impact. But more common in the environmental space is you have some constraint on another capital. So natural capital is the obvious one. If you're a company that is dependent on clean air, for example, if you operate in the Houston area, where there's frequently an ambient air quality standard violation for the Houston area, you are dependent on clean air. Otherwise, you have to pay to clean your emissions before they go out into the atmosphere. And so if that air becomes less clean, you have to pay for it because of the regulation, because you have a constraint on natural capital. We can also have other capitals creating constraints as a result of environmental impacts. So human capital is an example that's brought up a lot. If your employees deeply care about the environmental performance of your company, and you show that you're not environmentally responsible, then you could have employees either leaving or less willing to come to work for you, or asking for a premium on their pay in order to work for a company that they consider to not be as responsible. And this is fairly well documented in the literature, although very, very bespoke to different sectors and different companies. So this one of these three ways takes an environmental risk outside the company, an environmental externality, and internalizes it into a financial impact within the company. So hopefully we all kind of understand and we're on the same page about that. Let me just give a few examples of what I mean by this. So I took Shein as an example, just because most people know the company, not because of any particular insight that I have into them. So Shein is a fast consumer goods company or fast fashion company. Um, so let's look at a few different ways that an externalized risk could manifest itself as a financial impact. So one would be that someone identifies a human rights risk or human rights violation in their supply chain. That results in a consumer boycott, which is a form of civil society action, which results in a loss of revenue or sales to the company, financial impact. Another one, there's an energy cost rise. Globally, energy costs are going up. This means that the commodity price of plastics is going to rise, which means the cost of goods sold for Shein is going to rise because they rely on plastic wrapping for almost all of their products, which they ship around the world. Third one, pure natural capital externalization. We see increased frequency of severe weather / sea level rise. This means that this company is going to have to move processing or manufacturing facilities over the next 5 to 20 years, which means the cost of goods sold is going to go up because they'll have to pay for that in their overhead. So these are just some examples of how these externalities can create financial internalities. So the next step is to assess those internalization pathways. How do we understand the nature of that internalization? And the way we would normally do this is we do 2 phases. In phase 1, we look at 3 aspects. First, we want to know what is the probability that this external risk is going to be internalized to the company. For example, if I am heavily dependent on maritime transport, then severe weather is going to have a likely impact on my supply chain continuity over the next 20 years. So that would be a high probability over a certain length of time. We also want to understand the magnitude of the internalization. Are we talking about cents on the dollar for our revenues, or are we talking about percentages on the dollar, or 5, 10%? And the higher the magnitude of the potential internalization, then the more significant it becomes as a risk. And finally, the time frame. Are we talking about something that could occur at any moment, very, very, very acute type of risk? Or are we talking about a very chronic risk that will occur over a long time period? That's phase 1. And then phase 2, we need to understand the quality of the management controls that the company has to mitigate that risk. So it could be that I'm very exposed to severe weather and supply chain impacts. But if I have a very diversified supply chain, if I'm pulling materials from around the world, then severe weather in one part of the world is going to have a much, much smaller impact on me than if I were completely dependent on that one port that is being shut down for a period of time. So the quality of the management systems to mitigate that risk is also important. Why do I talk about all this? Why am I going over internalization pathways and how environmental risks can internalize and become financial impacts? The reason is because for each of those internalization pathways, I need to come up with a strategy to try and mitigate or avoid that risk. So just thinking about that last slide, that means I want to reduce the probability that it will occur. I want to reduce the magnitude if it does occur. I want to extend the time frame if it does occur, so that it occurs over a longer period of time, giving me more opportunity to fix it or avoid it or hedge against it. And finally, I want better and better controls for that risk. So there's a variety of different strategies that we can use for environmental performance or environmental externalities. One strategy I can use is to reduce the probability that it will occur. So just let's think of a couple of examples, and probably the easiest ones are from the human capital side. So we all know that health and safety accidents, incidents, injuries, et cetera, cost us money. There's liability associated with them. There's fines associated with regulation. There's lost time because people will be out of work. There's insurance costs associated with higher accident rates within my company. So we know there's costs associated with health and safety. And the magnitude is very, very difficult to avoid. That would be a very bad strategy to try and reduce the magnitude that I would have to pay for a health and safety incident. It's much easier for me to reduce the probability that it will occur. So I do a number of controls to try and reduce the probability of health and safety accidents or incidents. I could have a safety management system. I could train my employees. I could put safeguards on my machines, et cetera, et cetera. All the things that we're very familiar with health and safety. It's all in a strategy to prevent the probability of the internalization. Another one on the human capital side is professional development. I might, for example, have a constraint on human capital coming up where I need more engineers. There's no engineers in my pipeline. And it's very difficult to find engineers. So what's my strategy to mitigate that risk? Well, I'm going to try and mitigate it by reducing the probability that I will need to hire more engineers. And one way to do that would be to make sure that I train the people that I already have to do the engineering work that I'm going to need. So again, I'm just trying to reduce the probability that that risk will internalize to my company, that risk of not having talent. Second mechanism that we can use is to reduce the magnitude of the financial impact. Very, very common. The first two are hedging and insurance. So if that impact does occur to my company, if I'm hedged, it means I have a number of other sources, or I've got long short-term contracts, whatever the nature of the risk is. Hedging is a very, very common strategy to reduce that magnitude. Insurance, again, I'm just transferring the risk to somebody else. If it's a low probability event, high probability or high magnitude event, insurance is a wonderful solution to do that. The third one is to build up capital in advance of the risk occurring. And I circle this one because I'm going to talk about it in the next slide a bit more because it's very, very relevant to greenwashing. But the basic premise here is that those companies that have a lot of capital stored up are better able to weather an incident or the magnitude of an incident when it does occur. And let me give an example from the financial world that just happened recently, which was the FTX crypto company. So this company had a financial capital constraint, i.e. it didn't have cash. It had a lot of debts. And once one lender decided that it was feeling a little bit uncertain about whether this company had the ability to repay, it called the loan. And then every other debtor or lender, then called their loans as well. And this company did not have sufficient capital on hand to pay off those loans. So that is a financial capital constraint, and they did not have sufficient capital built up to weather the magnitude of the impact. You can imagine, or you can describe any other of those other capitals: human capital, social capital, environmental capital. If you don't have sufficient capital built up when the incident occurs or is internalizing, then you will be unable to respond because you won't have sufficient capital, and you'll go officially or unofficially bankrupt as a result. So building up capital is an important strategy that companies use to weather internalization of risks, specifically to reduce the magnitude of those risks. And I'm going to touch on that again in just a moment. Fourth strategy we have is to try and lengthen that time frame over which the risk occurs. Why do I want to do that? Because that gives me more time to get out of the mess. A classic one is supply chain diversification. If I am wholly dependent on one supplier and that supply chain is disrupted for whatever reason, if I have no way to bring on a second supplier within a short period of time, then I'm going to have to shut down operations for a period. However, if I've got 2, 3, 4 suppliers that can bring the same quality, type, and price of product to the table, then I'm going to move on with business with no disruption whatsoever. And anything in between, reduces that internalization or the impact of that internalization. So very, very common strategy is to try and lengthen the time frame over which it occurs, so that I have time to react. And the final way I can reduce these internalizations is to have better management systems in place. I only highlight 2 here because I think we're all very familiar with management controls. But one is, for example, business continuity planning. If you have a disruption, say you have a power outage within one of your manufacturing operations, if you've got a generator on site, you're up and running within seconds. If you don't, and you have to wait for the grid to come back online, then you're out of business for however long that power restoration takes. Another one that we don't think about very often is public relations. That the nature of some crises, the nature of some internalizations is based on the perception of a key stakeholder or a number of key stakeholders. And so my management strategy is to convince those stakeholders that we are still doing a good job. Public relations, and particularly lobbying, is a classic example of this. I work with governments. The government suddenly sees my company as doing something that is, irresponsible or something that they don't like. Perhaps, for example, I'm set to lay off 10,000 employees. Well, the government's not going to be pleased with that decision. And that's why I have a team that is working with the government to, tell them how we're going to bring those jobs back, or how we're going to contribute to economic development otherwise, or how the remaining jobs are going to pay better. Whatever your message is to the government, that's what those teams are doing. And all you're really doing is you're trying to convince people's perception in order to reduce the impact of the internalization. And I circle the second one because, again, this is a key aspect for greenwashing and where this comes in. So let's talk about those two. Let's talk about building capital and building up public relations. So both of these are strategies where greenwashing can be effective. So what does greenwashing potentially get you? The first thing it can do is it can build up this capital of reputation around your green credentials. There's a very interesting article that actually came out of Yale about a month ago, where they were looking at companies that were coming up on a short-term earnings shortfall. So their quarterly earnings call was coming up. They had a very small shortfall to their earnings expectations. And so they needed to find cost savings, those companies, in order to meet their quarterly earnings. And one of the places companies were very, very frequently found those cost savings was essentially turning the dial down on their pollution abatement. So essentially polluting a little bit more shortly before the earnings call in order to save costs on their pollution controls so they could make their earnings. And it turned out that companies that had stronger environmental performance and reputation were much more likely to do this than companies that had very, very little environmental reputation. And this is an example of a company that has more environmental capital in the bank, as it were, and they can spend a little of that capital in order to make their financial returns, in order to convince shareholders that they're doing a good job. If you don't have that environmental capital built up, then you don't have the option. You cannot reduce your pollution control because you're already under the microscope for pollution issues. And those companies didn't have that flexibility. They didn't have sufficient capital built up in order to convert it into financial capital in that situation. So greenwashing is a way to build up reputation, particularly on the environmental side, so that when this issue does come calling, you've got some capital in the bank so that people believe that you're still doing the right thing, even if something poor happened for a short period of time. So this can mitigate the internalization whenever there's a perception-based risk. Now, I use the word greenwashing here. You can do this in a number of different ways, right? You can tell a good story without actually doing anything. And if the perception is that you're doing a responsible job, that you're being green, you can still build up that capital. And in some circumstances, that will protect you when the internalization occurs. The other way to build up green capital is to actually improve your performance on environmental issues, and then promote those through public relations. Again, the difference only being the question of whether you're doing it, deceitfully or earnestly, or whether you have other conflicting priorities within the company. But either way, I'm using that public relations strategy to build up capital. The shortcoming of greenwashing is twofold. The first is that greenwashing strategies, of all those different strategies for reducing the internalization, it only works for a couple of them. It only works for building up capital, reputation-based capital, and it only works for and it only works for that the ability to reduce the risk after the risk occurs through public relations. So you can go to your regulator, you can go to your consumer and say, look, we've been doing a great job at this for a long time. We made one mistake. It's okay. You can continue to buy from us. You can continue to support us, etc. It does not work for the other internalizations. It doesn't work for any kind of resource constraint. For example, if you're dependent on a particular environmental resource like a mineral or clean air, greenwashing won't help you. It doesn't work for any kind of physical risk. For example, severe weather, greenwashing is not going to help you. So it's a very specific strategy for reducing the impact of internality or internalization. That's the first thing, is that greenwashing is very, very limited in terms of its strategic value. The second is, of course, the caveat emptor, which is that there's a number of factors that make building your capital and building your public relations on greenwashing, the deceitful practice, it makes it quite dangerous. So one way is that greenwashing tends to unravel much, much more quickly when the risk materializes. So let me go back to that company that has built up an environmental reputation. The short-term earnings is coming up. They are going to fall a little short. This company needs to draw on some of that reputation, some of that capital in order to make up the shortfall. So they turn down the dial. They release a little bit more toxics for, say, a month or two. Their pollution out into the river goes a little bit higher. All these things are monitored by the government, but not illegal. Just, we'll see a blip in their performance. So if all of that reputation of being a responsible company was based on non-performance, i.e. it was greenwashing, when you turn that dial down and you increase the pollution, the reputation, if someone keys in, they're much more likely to key in on that during that time when you turn the dial down. Or to put it another way, they're going to increase their focus on you when you do something poor. And if there's nothing to back up that behavior that you had built your capital up on, then they're much more likely to expose that at the time when the risk materializes. So it's when you try to draw from the capital that people are more focused on what you've done in the past, and that's when the greenwashing tends to get exposed. Not during normal operating conditions. It's always when the risk is internalizing that people focus and we get exposure on the issue. That's the first reason we need to be very, very careful about building a capital improvement plan or a public relations plan around greenwashing claims. The second, which everyone hopefully has heard already, is that we are moving into this place today of radical transparency. So it used to be that if I turned down the dial on my pollution equipment, for example, the only stakeholders that would know would be a regulator, maybe a month or two down the line when the sampling data came back to them, and then they would get put into a file somewhere. But that's no longer the case. Now we have environmental watchdogs on almost every river in the United States, for example. We have satellite imagery that is tracking emissions at a plant level or operational level. We've got community watchdogs that are paying attention to every large polluter. So if you are going to increase your pollution today, there are people that are watching, and there are people that have the ability to transmit that information widely, to create campaigns around it, et cetera. And there are a number of organizations who make their money through that sort of information. They are building up, for example, donor profiles or lawsuits where they can charge legal fees, et cetera, when they see that kind of information. And they're not waiting for the government data to do it. And that's just the example of pollution. It's across the board that we're in this place of radical transparency. And it's getting increasingly difficult to reduce your performance on human, social, environmental issues without someone taking notice. Third reason is that when that risk materializes, the people who are most interested are the ones who are generally the most influential. And those are the same people who are much less likely to rely on unsubstantiated information. And unsubstantiated here would be greenwashed information. So back to that pollution example. The people who care that you increased your pollution for a short period of time could be, for example, the regulator. They're incredibly influential, and they're very, very unlikely to look at your claims from your sustainability report around pollution. They're much more likely to look at your data for pollution that came out of your plant. And that's true across the board. Influential stakeholders tend to use data and not rely on your claims. And so it's much easier for greenwashed information to unravel because of that kind of focused influential stakeholder perception. The last point here is that it can be tempting to say, well, the one bastion of successful strategy for greenwashing is around really broad populations like consumers, civil society, policymakers. There's a lot of these people. They have a wide range of perceptions. They think about the issue on almost every level. And so it's tempting to look at those groups and say, well, surely that is where greenwashing claims could stand up, where I can create a great story. I don't have to back it up with a huge amount of cost and data. And when the internalization hits, those people won't all be looking at me and deciding that I'm a bad company. But just remember that sword cuts both ways. So when that incident does occur, those same people that were on board with the greenwash claims can go on board with somebody else's anti-greenwash claims just as easily. And so it's very, very difficult to rely on your public relations department to sway consumer and civil society opinions, particularly in a time of crisis. And it tends to be a fairly bad strategy because it's almost 50-50 as to which way those perceptions will go when the incident does occur. So overall, it can be it's a fairly dangerous strategy to build up capital or to base public relations around greenwashing claims. But we need to walk through the internalizations to really see why that is the case. All right, so let me flip the script a little bit and ask, so if I'm not greenwashing, what's the business case for a more genuine approach to sustainability? And I'll do this fairly quickly because I realize I'm running a little slow. So there's just a handful of ways that, and I'm not going to kind of go over the more speculative ones. I'm going to cut to the ones that have actually financial materiality. And those are, we use environmental performance to cut costs, we use it to lower risk, or we use it to drive growth. Cutting costs is the most obvious one. I've given one, probably the most famous chart in driving cost cutting through green or environmental performance there is. So this is the famous McKinsey GHG abatement curve. Anything to the left is going to make you money while also improving environmental performance. There's a lot of stuff that will make you money while improving environmental performance. There's a lot of stuff that you'll have to pay for in order to drive that environmental benefit as well. But it's not hard to reduce costs through environmental efficiency, particularly if there's any kind of energy tie. Driving growth is also fairly well established. It's just bespoke to different companies and sectors. Companies that are highly dependent on innovation, then human, social, environmental capital investments almost always pay off over a time frame of 10 to 30 years. Any company that relies on consumer perception for high margin goods, think like Patagonias of the world, they tend to do better if they make sustainability claims that are backed up with data and information. Margins can go up, just depends on the type of product that you're selling. You can drive value from a customer perspective and therefore profitability, but it depends on the customer. So I'm not going to claim or state that every company can benefit from more green products, but big chunks of the economy can. And then finally, we need to be strategic about this. Everyone remembers back in 2008 when British Petroleum had become BP, and then they became Beyond Petroleum. And while they were building up this public relations approach of a green, more renewable energy dependent company, they were dropping the ball on health and safety at the same time. So then we had the Macondo oil incident, we had the Texas City refinery accident, we had the Alaska oil pipeline spill. So they were letting their guard down on health and safety while pushing this public relations around a more responsible company. And because the two were at odds with each other, it all came crumbling down on them. Fast forward to today, now BP is having another go. This time it's about diversification into an energy company. Time will tell whether or not BP is being genuine about this, but in some ways they are being forced to become an energy company because the government and wars abroad are forcing them to divest from oil and gas assets. So why do these initiatives fail? And I've highlighted a few just that are relevant to greenwashing. If you make claims and you don't follow up on them, that would be overpromising. That would be greenwashing or a form of greenwashing. If you make claims and you're not transparent about the performance data that underlies them, then when the internalization occurs, it will be exposed because the people who are most influential will be looking for the data. If you make claims, but you don't execute on those claims, then someone is going to realize that, a year ago, 5 years ago, you said that you're going to be, say, net zero, and now you haven't met those targets, and someone will open that Pandora's box up. So there are a number of ways that greenwashing can help to make sure that your sustainability initiatives fail. So how to avoid it? It's actually pretty easy. In fact, it's easy enough that I just grabbed it from a website. Make your claims easy to understand. Back it up with data. Make sure that you're comparing apples to apples. If you are making comparisons of the green credentials of your product, make sure that, and you say it's better than your competitors, then make sure that you're comparing your performance against the same type of performance of your competitors. If you claim that your bottle is 70% less plastic than your competitors, then you better make sure that they're the same type of plastic. Otherwise, that will be exposed. Clean up your operations. The worst thing that could probably happen is that you make claims around environmental responsibility, and then something terrible comes out of your operations and affects local communities. Being honest about your practices and plans, whether they're perfect or not perfect. And then finally, don't be misleading, which is just another form of greenwashing. I think that's it. I'm going to stop there. Sorry, I went a little bit over time, but hopefully good 20 minutes or so for questions. You are muted, Terry. You're still muted, Terry.
Okay. Am I now not muted? Okay. Thank you. Todd, thank you. That was a fabulous overview. I'm encouraging people to start sending in questions. We also have some queued up, but let me start with one of the live questions from Tammy. Who should own the ESG function and oversee the data, reports, messaging in the company?
Ooh, I love this question. So the answer is, it depends. The advice I always give to companies when they ask this question is, you have or need to undertake a materiality analysis of your ESG factors. Why do we need to do that? It doesn't need to be boiling the ocean. You don't need 100% perfect materiality assessment, but you do need to understand what the priority ESG topics are for your company. You can just go at this really light and say, well, we're a manufacturing company. I'm going to use the Sustainability Accounting Standards Board standards for manufacturing. I'm not even going to do it myself. I'm just going to trust that SASB's got it right. Whatever you do, you need to understand the priority issues for your company. How does that answer this question? Because the person that controls most of those priority issue areas is the person that should be in charge. So if most of your ESG risks are a part of your operations, then your chief operating officer should be the person that is in control of ESG, or at least one of their deputies. If most of your risks, like Sheehan, sits in the supply chain, then the head of procurement needs to be in charge of ESG. If most of your risk is perception-based, right, and about intangible value, then your head of marketing and communications needs to be in charge. So it all depends on the nature of the risks, the priority risks that you have. That's the person that needs to be in charge of ESG.
Okay. Other questions? I'm encouraging, here we've got one from Larry. In our society today, lying has become commonplace. How can we punish firms that engage in greenwashing?
It's another great question. I frequently get this question in a slightly different form, which is, it's usually who should punish firms for greenwashing. And the question is then caveated, should it be, for example, the government that puts in regulations, or some sort of punitive actions for companies that lie or caught greenwashing? Should it be civil society acting through the courts, for example? Is it the responsibility of consumers to punish those companies, et cetera, et cetera, et cetera? But you've asked the how. And the how and the answer to the who, they're kind of both the same. And that answer is that it's very, very difficult to put in new mechanisms, new punitive mechanisms around greenwashing. However, there are a number of existing mechanisms by which society can act to punish greenwashing. Some of these are fair and some of these are not fair. So let's take the most unfair one. Customers can punish you for greenwashing, but customers can also punish you for trying to do the right thing. It's just not fair. And it's, this is a natural or a normal function of business, is to try and please your consumers, convince them that what you're doing is right, and hope that they won't get too angry if something goes wrong. The most common way we see punitive action on greenwashing coming through now is through the courts, through civil liability. There's a really interesting, I'll point you to another Yale publication. We put out a paper a few years ago around greenwashing and puffery. And puffery is the legal term for marketing claims that are unsubstantiated. And puffery is used a great deal in marketing speech. And for the most part, US courts have protected companies from marketing speech. You pretty much have to have an egregious and three things have to happen. It has to be an egregious lie, essentially. It has to be demonstrably false. But the biggest hurdle is actually the person suing has to have standing. So the person that's suing you for your greenwashing has to show that they have had damages as a result of your greenwashing. And them just buying your product on the basis of your claims is not standing, according to the courts. So the most successful civil litigation around greenwashing has come from companies that have shown systematic efforts to misinform investors. So that brings me to the kind of third answer, which is who's most likely to get some damages out of companies for greenwashing? It's investors. Investors have automatic standing. Investors also have regulations to protect them through the Securities and Exchange Commission. So it's investors primarily that are going to be the punishment for companies that greenwash. Now, why would an investor punish you? Because you didn't manage the risk and they lost money. So it all gets back to the strategies that we use as a company to mitigate risk. Be sure that you're using greenwashing very, very judiciously, because if you lose money and your investors find out that they lost money because you were basing it on false data, then they have standing. You'll probably lose in court. You'll get fined by the SEC, and you might have some additional damages. So those are the current mechanisms. Very, very unlikely that we're going to see any other kind of new mechanisms come through.
This next question comes from Michael. Great presentation, Todd. Will the current harmonization of reporting standards, new reporting regulations, and greenwashing rules help or just confuse the reporters and their stakeholders?
Yeah, another great question. It's going to be a little bit mix of both. So remember, one of the ways to avoid greenwashing was what the website said was apples to apples comparison. That's where it's going to help. So there are some ESG factors that are going to be standardized, and specifically we'll have accounting standards for those factors. Scope 1 greenhouse gas emissions comes to mind. So we're all going to be talking about the same thing in the same way with the same scope and boundary. And it will be much, much more difficult to greenwash in that circumstance where we have apples to apples comparison. That doesn't solve the issue. That just takes a chunk of the challenge and puts it onto a different table. The vast majority of environmental responsibility, this big balloon of environmental responsibility, is not going to be standardized. There's going to be no regulator, no accounting board or accounting standards board that steps in and says, we're all going to talk about every aspect of environmental performance in the same way. There's always going to be an opportunity for companies to either create competitive advantage using environmental claims / greenwash, depending on where on that range you sit, could be one or the other. So that'll always be the case. And we are also in the world of enormous data. And the previous question was, lying has become so normalized. I would almost argue that big data, and statistics as a lie have become so normalized. I can use data to say anything at this point. you guys remember the rat study where rats were getting cancer from chocolate because we fed them like 2 pounds a day. I can use data to show anything at this point. And so that will continue to expand. There will be more and more opportunities for companies to use more and more types of data in more and more different circumstances to make claims that they need. And you can either use that data to try and hide stuff, or you can use that data to try and show performance. They're both strategies to reduce the internalization. I just want to warn companies or suggest to companies that one of those is more costly, but also more solid as a strategy.
Thank you. Next question from Larry. Engaging in sustainable practices, and in particular, the use of renewable energy, will result in cost savings for commercial enterprises. Nonetheless, many firms resist sustainable practices. Is there a good way to help these companies evolve? And I think you've touched on this, but
yeah, I mean, it's a big question. It's obviously a great question. One I can't solve because it's so big. Let me instead say there's a number of different ways that evolution can occur. So there's, for example, let's think about that McKinsey cost curve, for example. There's some chunk of energy savings that are cost effective that also reduce greenhouse gas emissions, right? So those are, in theory, no-brainers. But there's economic conditions that underlie that, both good and bad. One is that it's easy for me to say to a company like, you'll save 2% of your energy cost every year if you replace your light bulbs with LEDs. And on face value, anyone would say, well, it's a no-brainer. I'm going to go buy some LED lights. But the reality is that I'm not just saying, is it cost effective compared to zero? I'm saying, is it cost effective compared to an internal rate of return? Could I use that same money and invest it in something else and get 5% back? Well, then I'm not going to buy the LEDs. So that's kind of on the downside for economic factors. On the upside for economic factors, there's actually some things that would normally cost money to reduce greenhouse gas emissions that I can make money out of through, for example, portfolioing. The quick example is I want to convert my coal-fired power plant to natural gas. Well, if I'm doing that, I've got to shut the plant down, do major manufacturing retrofitting. If at the same time I also put in a carbon sequestration system, which normally would have cost me a ton of money and never would have paid back. If I do it at the same time I'm retrofitting the plant anyway, I can actually make money out of a carbon sequestration system. So economic factors are one way that evolution could occur. How do we shift economic factors? Either the price of the thing has to come down, the demand has to go up, or the government has to put in an incentive or a penalty. Those are the only ways that the macroeconomics change. So prices for renewables coming down. Great example of the market is moving because the prices are low. Not quite internal rate of return low yet. That's why we don't see it, the switch flipping, but still, much better than zero. But the price for shutting down a coal-fired power plant, really bad economics right now. Even though coal is going bankrupt and the cost of coal is going up, just doesn't make sense yet. So that's the economic side. Then there's the regulation side, which is regulation incentivizes, it penalizes, but most importantly, it kickstarts. So it lays a path to say, this is an industry that we want to grow over the next 5 to 10 years. And so we create the incentives for that industry to grow. So solar and wind in the United States has been growing over the last 10, 15 years more because the government put in place the technology incentives for to bring the cost down. So those, that is the, how do we get these companies to evolve? We have to create the economic and government structures for them to do it. The last way to do it, and this is my one controversial statement I'll make today, is we need to get rid of quarterly reporting. That is probably the number one way that I can point to get companies to evolve. Why does that get companies to evolve? Because if my earnings reports are not quarterly, let's say they're annual instead, then my risk assessment and my internal rate of returns are based on a 1-year horizon, and as opposed to a 3-month horizon. And that makes a world of difference when we're talking about environmental risks. The farther out my planning horizon, the more the internal rate of return calculations make sense, because environmental consequences add up over time, not over 3 months. So quarterly reporting is just a disaster for environmental performance. Over the long term, almost every CEO that you talk to would say, if everyone asked me for my 20-year strategy, I would definitely take on environmental responsibility stuff because it would pay over 20 years. But that's not how I'm being evaluated. I'm being evaluated on a quarterly basis. Environmental stuff doesn't pay on a quarterly basis.
Todd, thank you. Our time is shortening, and I want to ask you one final question, somewhat unrelated to what we've been speaking about, but I think it will help the audience get to know another aspect of who you are. Would you? I know that you're passionate about studying organic winemaking. Would you please share a bit about your coursework and what you anticipate going forward, and when you're going to be able to make your own wines that we can taste?
I don't know that I'll ever make wine. I don't see that as a sustainable lifestyle for me. What I'm interested in is, I mentioned the multi-capitals, social, human, environmental, financial, manufactured, and intellectual capital. There's the business case. Think about the most sustainable business you can. The most sustainable business you can think of is the one that maximizes all 6 of those capitals. And the best examples of businesses that I can find that are maximizing cultural value and environmental value, et cetera, are coming from the agricultural space. So I was kind of faced with this question of, do I want to, eat wheat or drink wine? And I'd rather drink wine. So what I'm really passionate about, what I'm interested in, is how do we use wine and the growing marketing, sales, public relations, et cetera, of wine to demonstrate, to operationalize a truly sustainable business that maximizes all 6 capitals, not just financial capital. I think it's a great test case. And so, yeah, I'm studying wine, have been for 4 or 5 years now, from everything from the planting of the rootstock up to how it sits on the shelf, because I think that it's a fascinating case study and pilot for what the next version of capitalism could look like.
It's inspiring. Thank you for sharing that. I want to thank you for the fantastic primer on greenwashing and for answering so many of our questions. Todd's slides, along with a summary and the recording link to this webinar, will be posted on the LINKCO website with the link to the LINKCO YouTube channel. LINKCO's upcoming webinars are also always listed on our website. And I'm most pleased to announce that our next webinar will be on February 1st, same time, with, by popular demand, returning Dr. Rita Campileth, the acting director of the LA County Chief Sustainability Office. The link to that is in the chat for those of you that want to sign up already. And at the end of the webinar, please take a minute to fill out our survey. It will help us evaluate and improve our series going forward. And thank you in advance for your feedback. LINKCO Executive Search provides elite companies with top C-suite and upper management talent nationwide using a proprietary step-by-step process for both clients and candidates. When you need help, please call upon us. Have a happy holiday period. Thank you so much for taking the time to join us today, and stay safe. Thank you so much.
Thank you.